Hey guys, welcome to the first video of planned investing. On this channel we will talk periodically about the health of the stock market, my insights on equity market conditions in the near future, as well as my favourite stock picks to have in your portfolio. In this first episode I will be discussing my opinion on what I think lies ahead for US equity markets in the month of May. In order to effectively tackle this question, I will be recapping what happened during the month of April in the stock market, drawing upon key health and economic data to help guide my reasoning. To help make this information digestible to all viewers, I will be presenting this data using a simple PowerPoint. As we can see, the month of April was a historic month for the stock market, with the S&P having its largest monthly increase in nearly 33 years, gaining around 12.7%. The S&P closed the month of April at roughly the same price level it was at a year ago, in many ways seeming to completely overlook the coronavirus pandemic and its economic implications. Such impacts are clearly visible, with the US economy contracting 4.8% in the first 3 months of the year. This downturn is the steepest since the Great Financial Crisis in 2008. In addition to this slump, the shutdown of the US economy has caused drastic unemployment, with US jobless claims reaching 30 million in merely 6 weeks. Secondly, earnings season has helped shed some light on the economic damages the coronavirus pandemic has caused for businesses. Many companies have completely yanked their quarterly guidance, such as AT&T, Unilever, and Apple to name a few. Such measures were taken as earnings visibility moving forward is still murky due to the lack of stable economic conditions. Further, the month of April demonstrated both the strength and duty the Federal Reserve has towards supporting the US economy. On top of the unprecedented actions the Fed has already taken to save the economy, such as cutting interest rates to a range of 0 to 0.25%, introducing lending programs amounting to $2.3 trillion, as well as continuing with unlimited QE, their last meeting on the 28th of April reassured individuals of their continued efforts to do whatever necessary to support the US economy. In other words, they're prepared to use all the tools available to their disposal in an attempt to keep the US economy afloat. Separately, little progress has been made in relation to finding a concrete medical advancement to help end this pandemic. Although some encouraging news surfaced on Gilead's drug remdesivir, which can help to alleviate the strain on healthcare services by diminishing the mortality rate and individuals' hospitalized time, this is only one of the many needed ingredients to put an end to this pandemic. As we currently stand, therefore, social distancing measures persist, with the majority of states still under lockdown. Despite the death toll at the peak or falling in most Western countries, the ease of current restrictions still seems unfeasible in fear of resurgence of cases. With these points in mind, we can attempt to rationally predict some likely scenarios that could play out moving forward into May. It is highly likely to see some retracement of April's gains. This is already visible, with the S&P falling 2.81% on the 1st of May. Arguably, the market has moved too far too fast, becoming somewhat overstretched at these levels. To put it into perspective, the S&P is only down 14% from the all-time highs in February. It is therefore fair to assume that the market will begin to lose some steam moving into May. This said, it is still unclear as to how much US equity markets will fall and whether market sentiment will be strong enough to retest the lows of March 23rd. Some concerns immediately spring to my mind with the market at such high levels. The current market valuation fails to recognize the potential that the virus may linger around for longer than anticipated, potentially halting or slowing down economic activity more than initially expected. The current market valuation also neglects the different economic environment that will surface in a post-coronavirus world. Those businesses that survive will have to substantially alter their underlying business practices, the way they engage with their consumers and deliver their products, all of which will take time and potentially increase costs for businesses. It is also fair to say that the market is somewhat effectively blinded by corporate earnings. The market is so divorced from the economic reality of the situation that it has failed to sufficiently price in the hit in earnings that businesses have taken this quarter. This is clearly visible, with many companies missing their quarterly revenues and earnings per share expectations. However, markets still rallying. More importantly, it is crucial to recognize that states which have started to relax restrictions, such as Georgia, may start to witness a resurgence in cases. If individuals and corporations start to act irresponsibly, ignoring the appropriate guidelines outlined by health officials, such a scenario may unfold. One must therefore monitor the transmission rates within these states, as a secondary wave of infections may be the catalyst to a strong market sell-off. In addition to the economy being sidelined by the pandemic, there is also growing concern regarding the possibility of US retaliation against China for allegedly causing the pandemic. Such retaliations will be in the form of tariffs or potential defaults on debts to China. Thus, it is important to look closely at the ongoing trade relationship between these two countries, as greater uncertainty will add pressure on the economic outlook. With these scenarios potentially unfolding, it is important to plan your investments and prepare ahead of time. One must keep a close eye on key technical levels within the market. Don't be seduced by the fear of missing out if the market was to rally, and instead, plan your investment decisions based on market behaviour around important levels of support and resistance. For example, if the S&P was to break 2720, which has historically been a significant level of underlying support, it is likely more downward movement will follow. Irrespective of the fact that successful investing should be executed with a long-term horizon in mind, using this simple technical analysis can help guide your positioning within the market, avoiding any premature trades. I hope you've enjoyed this video and found it somewhat insightful. If so, I would very much appreciate it if you could like the video and, more importantly, subscribe to the channel so that you won't miss out on any future content.